You found a house that you love. You've done the math, the payments work, and you feel like you're safe. But a pre-approval is one of only 3 things you need to do as you're putting in an offer. Get one of these things wrong and your purchase can still fall apart. And the first problem can come down to one word on your job letter. These probably sound like they mean the exact same thing. You're working 40 hours either way. But for a mortgage, the difference between averages 40 hours a week and is guaranteed hours a week can play a huge role in whether you get the mortgage or you don't. If your employer says that you have guaranteed 40 hours a week, banks will be able to use your hourly rate times those guaranteed hours to give you your yearly income. If the job letter states that your employer gives you an average of 40 hours a week, the bank is going to look at that as if it's a variable income. The bank's going to need established 2 years. They're going to average your income over the last 2 years. So if you recently gotten a raise, had a bad year, that could substantially hurt you. It gets even worse if you haven't worked in the same field or the same job for 2 years. And this becomes a huge issue if you've only been at your job for 6 months or a year. You may be earning $80,000 a year, but to the bank, they can't use any of your income. More than half of the job letters that I receive from employers state initially that the job has an average of 40 hours a week. Often this isn't because the hours aren't actually guaranteed. It's just that HR is using their standard wording. And what I'll do in this situation, I'm actually going to go back to the employer and ask, are these hours actually guaranteed? And if they are, I'm going to make sure the job letter reflects that. And this is why I have a very simple rule. If someone hasn't reviewed your documents, you have not been pre-approved. And a quick conversation of your income, your debts, it can get us into a ballpark of what you're pre-approved for. But that number is still based off of so many assumptions that it really isn't worth anything. And before you fall in love with a house, wouldn't you want to be comfortable knowing what you'd actually be pre-approved for? That's why we're taking a look at your income documents, your credit, your down payment information. And we're making sure that any unusual income or debts are classified and make sure that the lender's on board. There's a big difference between being told what you should qualify for and actually having someone review your documents to make sure what you actually qualify for. So let's say we've done all that. We've taken a look at your income, your credit score works, your down payment is there, and the bank's completely comfortable with you as the borrower. You still aren't done because the bank then needs to look at your house. This is the thing that most buyers miss. They get their pre-approval and they go shopping and they look after house after house after house and they don't check in with their bank or their broker. That pre-approval is primarily about you, but now you're buying a specific property. So not only does the bank need to be comfortable with you, they need to make sure that they're comfortable lending to that property as well. And one of the first things that they're going to want to see is the MLS listing. And look, they don't care about the price. They don't care about the photos. They also don't care about how many bedrooms or bathrooms are in there. They're looking at the description, what type of electrical and plumbing there is, what heat sources are there. They want to look for anything that could cause problems if they needed to sell the home if you stop making payments. And this is why this is important. I had a client, amazing, very easy to qualify. She was the perfect candidate to buy a home. Now, she was looking at buying an older house. Okay, it needed a new kitchen, a new bathroom, and some other cosmetic renovations. But the house was perfectly livable. The client was going to live there. But in the MLS description, it was talking about the potential to tear down the home to make into a development. That it could be made into an apartment or the potential of multiple units in this one building. That it had the potential to be a low-rise apartment or to be made into townhouses. And from your perspective, that's great. You're not going to do any of that, but in the future, this could mean that your house is more valuable. But from the bank side, they're concerned, are we funding this as a property that this person's living in just for them to tear it down and start to do work on it, to start redeveloping this area? And when the MLS listing starts talking about tear down, they worry about how good the property actually is on the inside. And this created additional questions and additional documents that the buyer needed to supply the bank in order for them to actually lend on this property. So you got to understand that the wording MLS listing is not just marketing. It's not just there for you. The banks will read it as well. And that deal did fund as normal. So it doesn't mean that if a realtor has that in the description, that the property can't be purchased. It also doesn't mean that something that needs to be developed also can't find a mortgage on it. It just means that your bank or your broker should be aware of it before you put an offer in on the property. So before you put an offer in, all I recommend is make sure you're sending that full MLS listing in before you place an offer. And then there's one final approval that can't happen until after an offer is actually accepted. And that's the appraisal. And people think if I bought this house for $800,000, that the bank thinks it's worth $800,000 as well. And although that can be the case, it's not always the case. The appraisal is looking at 3 of the most recent comparables, houses that are as similar to the property that you purchased as possible. They obviously aren't going to find the exact house that you bought, so they do some adding and subtracting. They're usually pretty standard in terms of what they'll add and subtract and find a final value. Assuming that value is within the range you purchased for, appraisers are usually pretty good at making sure that the value comes in at what you paid for. But as we've seen with the Toronto and Vancouver condo market, in some cases, the difference between what you paid for it and what it's worth can be substantially larger. And the bank doesn't lend based off of the purchase price. It's the lower of the purchase price and the appraised value of the home. And so this can create a couple of different scenarios. This can mean that you have to have a larger down payment than you expected. It can mean that you have to go back and renegotiate with the seller if that's an option. Is that it can lead into a financial problem. And look, I don't want to scare you. The vast majority of purchases, the appraised value and the purchase price match. But the appraisal isn't just coming in there for value. They're going to take pictures as well. But the appraiser's not just looking for value. The appraiser works for the bank, and they're looking at the property on behalf of the bank. They're not a home inspector. A home inspector is somebody who's looking through the property on your behalf, trying to point out what is wrong with it. An appraiser is trying to see if there's anything wrong with it from the lender's perspective or the bank. They may see obvious damage, some significant unfinished work, or other things in the property that can require further investigation. And this can lead to more lender questions. It can lead to the lender asking you to fix those things before they'll lend you the full amount of money, or that the bank's not comfortable with lending on this property and declining it in general. I've made an entire video of what to do when you look through a house to determine these common pitfalls. I just want to make sure you're aware. But I think it's important to say that you can be a perfectly qualified borrower and something in the house is going to cause an issue when it comes to the financing of that home. So before you buy a house, there's 3 questions that you need to ask yourself. Number 1, for the pre-approval, has someone actually looked at my documents? Number 2, for the property, has someone taken a look at the MLS listing and read through it for any issues? And the 3rd is value. Does the property that I'm purchasing actually warrant the amount that I'm spending on it? And this is why adding a condition of financing and a condition of inspection can be so valuable to you. And the goal of this video is not to make you scared of making an offer. It's to know which questions have actually been answered already before you make one.